Global economic conditions remain robust as we enter the last month of the year. Strong economic sentiment has carried over into the month of December across major economies, with strong consumer sentiment and European manufacturing PMIs at a 17-year high. We remain negative on global rates, neutral on investment grade, and positive on high yield. In the UK, the Bank of England has linked the future path of the interest rate to Brexit developments amid a stabilizing economy. Hence, the positive momentum around Brexit talks should put pressure on gilts. In Europe, ECB President Mario Draghi has kept hawks at bay. Nevertheless, we remain negative on the Bund due to the unattractive risk-return profile. In the US, the future Fed Chair Jerome Powell seems to agree with the current gradual tightening pace. Upward revisions to Q3 GDP growth, taken together with the recently approved US tax reform, should put upward pressure on long-term yields. Global investment grade remains expensive from a spread perspective, but we do see value in selected names with smart beta characteristics. We remain positive on high yield, as strong global growth provides the bedrock for attractive carry collection. Given the upbeat macroeconomic environment and strong company fundamentals, we remain positive on US and European equities. The positive outlook remains intact despite negative performance in major benchmarks in November. The lower tax rate from the newly agreed US tax bill, robust consumer demand, and strong earnings growth should provide further fuel to the equities rally. We are more cautious on the UK, as any upside in equities may be neutralized by a stronger sterling as Brexit discussions gain positive momentum. Turning to currencies, we are positive on the sterling due to the increased probability of a Brexit deal and historically low valuations. We are neutral on the euro given the tepid inflation and Mario Draghi's commitment to monetary policy accommodation. The US tax reform should provide a boost to the US dollar, but we remain neutral amid concerns surrounding Trump and the Russia-related probe. On commodities, we remain neutral on oil and gold. The recently reached deal between OPEC and Russia should support prices against rising production out of the US. For gold, geopolitical risks remain the only driver as central banks are moving towards monetary policy normalization. I invite you to have a look at our monthly and quarterly publications, where you can find more information on the markets and our investment ideas.